Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Datadog.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Yeah, let's do it.
We saw just remarkable acceleration across the board in the latest Q3 results.
Right.
If you were watching the sector, this was a massive surprise. I mean, the whole narrative has been tight budgets, slow cloud consumption.
And they absolutely shattered those expectations. Total revenue came in so strong, growing almost 30% year over year.
It did.
But what was really, eye-opening for me wasn't just the number itself. It was the sheer momentum building just beneath the surface.
That momentum is critical. You're right. It tells us about future growth, not just what happened last quarter. So we look immediately at things like billings and remaining performance obligations, or RPO. And billings, which is a really good proxy for future bookings, it jumped 30% year over year.
And the RPO figure.
Yeah.
That was the real shocker for me. It increased, what was it? A staggering 53%.
53.
Yeah.
For anyone who's not familiar with RPO, this is basically all the contracted revenue that they haven't recognized yet. It's signed deals just sitting in the pipeline.
Right.
When that number accelerates like this, it signals just massive future revenue visibility.
Exactly. It's the market giving them this giant vote of confidence through long-term contracts. And, this confidence translated directly into their guidance.
It had to.
The company significantly raised its projection for fiscal year 2025 revenue. They're now anticipating growth around 26%. They're effectively telling the market, we underpromised and we overdelivered.
Okay, so let's unpack how they're doing this. I mean, for the last year, all we've heard is this endless chatter about optimization.
Companies tighten belts, cutting cloud waste, delaying IT projects. Datadog's performance suggests that phase is either over, or maybe more likely, the value they deliver just outweighs that desire to cut costs now.
That's the central question. Why, in this environment, are existing customers suddenly ramping up their spending?
Yeah.
And this is where the data gets really fascinating. The biggest surprise driver, it wasn't the AI customers.
It wasn't.
No. I mean, they're important, but the real story was the non-AI native customer cohort.
So the classic existing enterprise customers, what happened with them?
Well, management reported the strongest sequential usage growth for these exact customers that they have seen in the last 3 years.
Wow.
Their revenue growth accelerated to 20% year over year. This is a huge signal. It means the demand is broad-based. It's driven by fundamental digital transformation needs that. Well, they just can't be ignored anymore.
So it's not just the AI hype cycle.
It's not just the AI hype cycle.
That completely changes the risk profile, doesn't it? If the growth was all reliant on a few huge, cutting-edge AI labs, the business would feel fragile.
Much more fragile, yeah.
But if the core enterprise, which is far more stable, is accelerating its usage, that tells you the platform is just fundamentally essential.
Precisely. And they're not just relying on usage expansion. They're absolutely crushing it on the new business front, particularly with these large enterprise deals.
Whales.
The whales.
Yeah.
New logo annualized bookings more than doubled year over year. That tells you they're capturing bigger customers right out of the gate with larger initial contracts.
So can you tell us about one of these big wins? Because hearing the dollar figures is one thing, but understanding the scale of the displacement is another.
Yeah, okay. So one key highlight was landing their largest ever European deal. It was with a leading multinational telecommunications company.
The telco.
And this wasn't some small trial. They replaced over 10 competing tools simultaneously.
10 tools.
And consolidated the company onto 11 Datadog products right away. I mean, just think about the complexity of managing 10 different monitoring platforms. Now it's streamlined to one.
That's an immediate massive improvement in operational efficiency.
Huge.
And that kind of consolidation is what gives the platform its long-term stickiness, right? Once you're that deeply integrated, replacing them becomes an IT nightmare.
A huge project.
And they also had that crucial renewal that everyone was watching, the one related to one of their largest AI customers.
They did. And they secured a 9-figure annualized expansion with that customer.
Which must have been a massive relief for the market.
It was. There was this persistent anxiety that key relationship might decline in revenue as the customer optimized spending.
Right.
The fact that they not only renewed but expanded the deal, it validates their relevance to the most demanding, data-intensive workloads on the planet.
So they win these huge deals, but the real power of the business model is in the platform adoption. How many customers are still just using one tool versus the whole suite?
The platform's stickiness is still a defining characteristic of their success. The numbers really show a deep commitment to consolidation. At the end of the quarter, 84% of customers were using 2 or more products.
84%.
Which is up year over year. And even more strikingly, 16% of customers are now using 8 or more products.
8 or more. So that means they're using monitoring, security, networking, logging, all of it from one vendor. It's hard to even imagine switching away from that.
It really is. And a great example of this product maturity translating into platform lock-in is their digital experience suite.
Okay.
This includes things like real user monitoring or REM and product analytics. This suite alone now exceeds $300 million in annual recurring revenue.
$300 million just for that suite.
Just for that. And
Yeah.
product analytics is already adopted by over 1,000 customers. It just shows that the initial land might start with basic observability, but the expand phase moves very rapidly into these adjacent high-value services.
Okay, speaking of high value, let's pivot to the key tech catalysts. I mean, they've been investing so heavily in AI, not just as a workload to monitor, but as a tool to improve their own platform. What's the innovation that has engineers buzzing right now?
The innovation is moving fastest around 2 areas.
Yeah.
Security and AI operations. On the security side, their security ARR, the annual recurring revenue from those products, it accelerated dramatically.
Yeah.
It's now growing in the mid 50% range year over year.
And that's partly from bundling things like Cloud SIEM into the big deals, right?
It's a huge part of it.
Let's just pause on Cloud SIEM for a second.
Yeah.
For people who aren't in cloud security, what are we talking about here?
So SIEM stands for Security Information and Event Management. Traditionally, this was this completely separate, very heavy piece of software that ingested logs for security.
Right, a silo, a total silo. By integrating Cloud SIEM directly into their observability platform, they make it much easier and faster for a company to detect threats across their entire stack. The security data is already sitting right next to the performance data. That consolidation is a huge selling point.
Okay, that makes sense. Now let's talk AI. You mentioned the BITS AI SRE agent. And SRE is a site reliability engineer, basically the person who keeps the website running. So what does an AI agent do for them?
This agent it's a game changer. It allows for automated problem resolution. They've already onboarded thousands of customers to the preview.
Thousands already.
Yeah. Think of the SRE agent as an AI first responder that, doesn't need to sleep. When an incident happens, a spike in latency and application crashes, the agent jumps in immediately, investigates the root cause, and in many cases resolves the issue before a human engineer even gets the notification.
That's phenomenal. So instead of waking up at 3 a.m. to triage a problem, the engineer wakes up to a report that says, hey, this was identified and fixed. Precisely. The feedback from customers has been enthusiastic. They're saying the agent is significantly reducing their mean time to resolution for incidents. One user even noted that for most common issues, the investigation is fully taken care of before their human engineers even open their laptops.
That's just instant operational leverage.
It is.
And beyond fixing their own platform, they're also positioned to benefit from all the large language models, the LLMs that companies are now building. Are they seeing that usage yet?
Oh, absolutely. The number of LLM spans, which is how they measure the observability of AI models sent to the platform, has more than quadrupled in just the last few months.
Quadrupled?
Yeah, it just demonstrates that their tools are crucial for companies running these complex AI workflows in real time.
And building these huge models must create all sorts of new problems for customers, especially around cost.
It does. This is a critical pain point, and it's one the company is moving aggressively to solve. For companies building serious AI products, the cost of data storage and processing can often be the 3rd highest line item in their cloud bill. Sometimes it costs more than the AI model training itself. It's a huge area of waste.
That context, that's vital.
That's
So
true.
how are they responding to that specific pain point?
They just launched a new solution called Storage Management.
Okay.
This tool is aimed specifically at tackling the high costs of cloud object storage. Those massive databases where companies keep all their AI training data and artifacts. Storage management gives them granular visibility into that data use, proactive anomaly detection, and targeted recommendations to just eliminate cloud waste.
So instead of engineers just throwing data into the cloud and hoping for the best, this gives the finance teams, the FinOps community, the power to actually police those costs.
That's exactly right. It's a powerful tool for FinOps. It finds infrequently accessed data, duplicate data, inefficient storage patterns, and it tells the customer precisely how to save money.
So it makes Datadog not just a tool for engineers, but a crucial cost-saving partner for the CFO.
It does.
Okay, that rounds out a nearly flawless growth story. You've got broad-based recovery in the core business, accelerating AI adoption, fantastic new products. But we have to be balanced. For investors, what are the key caution flags? What are the risks?
The main concern, and it's almost always the case when a company performs this well, is valuation.
Right.
Datadog is not a cheap stock. The company is trading at highly premium multiples, reflecting all of this optimism we just discussed.
Can you get in some context on those multiples for a general investor? What does that mean?
Well, if you look at a standard metric like price to earnings or PE, this stock is extraordinarily elevated, sometimes in the hundreds compared to the average of major indices. It's priced for perfection.
Okay.
The price to sales multiple is also substantially higher than the software industry average. It means you, as an investor, are paying a significant premium for every dollar of sales the company generates right now.
So you have this incredible story backed by product excellence and accelerating usage, but the market price already reflects a huge amount of that future success. You're buying very high expectations.
That's the tension. You're paying a premium, and if they miss even slightly in a future quarter, the market could react violently.
But there's a counter-argument, isn't there, based on long-term potential?
There is a strong one. If you look at a discounted cash flow model, which tries to estimate the company's value based on future cash generation, it suggests that if they maintain this growth and efficiency, the stock could actually be technically undervalued by 25% or more.
That's the classic high-growth conundrum, isn't it? Short-term premium multiples versus long-term cash flow potential. It really depends on your investment horizon.
Exactly. And one final specific risk to keep in mind. Even though that massive AI customer renewed, some analysts are still cautious. They're forecasting a reduced contribution from that single customer in fiscal year 2026.
So concentration risk is still a factor.
It is. While the diversification is improving dramatically, that reliance on one or two huge accounts remains a consideration for anyone focused on near-term revenue certainty.
So the central tension here is whether this fundamental acceleration we're seeing from non-AI customers, from the SRE agent, from these new cost management tools, can sustain the pace needed to justify these really high valuation metrics.
That's it.
It all hinges on their ability to keep converting that groundbreaking innovation into broad customer consumption and, ultimately, massive future cash flow.
It makes it a fascinating investment case study in growth versus valuation.
If you found this discussion useful, please take a moment to subscribe and support Smart Wealth with Joshua.